Hi, welcome back to another case study video. This time around, we have yet another eye-catching title. What is worse than having a portfolio with a $618,000 worth of unrealized loss on a $1 million portfolio? So this essentially means that the portfolio is probably down around 60% from its all-time high. And essentially, I've reached out to the author of this blog, Learning Investment with Syfe. So I wrote into him and I requested for an interview with him. But I guess because he wanted to keep a lower profile, so instead we'll be doing some sort of a monologue in this video, where I basically wrote my questions into him via Word doc, and he very kindly took the time to reply. And this will essentially be me narrating the two specific blog posts that I think there will be great value add, and also a little bit more nuance and details in some of the questions that I'm interested in asking him. And of course, before we begin, remember to like that smash button. And I would just like to take the time to thank today's sponsor. Introducing today's sponsor, Skillshare. So Skillshare is an online learning community with thousands and thousands of online classes for all sorts of topics. They have a wide range of topics from personal finance to productivity and even how to start your very own YouTube channel. So like investing, I think the biggest asset in your life is not your stock portfolio or even your property. It's yourself. Like everyone else, when we are at home, we always have that inertia and procrastination inevitably kicks in. So right now, I'm taking a class from Thomas Frank with regards to productivity and how to build habits that last. As Skillshare is sponsoring this video, the first 1,000 people to use the link down in the description below will get a 1-month free trial of Skillshare Premium Membership. Now, before we start proper into diving deeper into the two blog articles that he posted, I just wanted to catch you guys up to speed into understanding who Jason is. So what should the viewers know about you? He replied, I'm a simple guy who wishes to change the world for the better through every little effort that I can give. And evidently, you can see that he's kind of giving back by writing publicly, even though he's probably going to be met by a disproportionate amount of backlash and a lot of trollers and essentially jokers online. So anyway, I just wanted to understand what essentially inspired him to start sharing his journey so publicly online. So I just hope to help someone, whether he or she is a newbie investor or someone who has lost lots of money in the stock market. So for a newbie investor, I hope they learn from my mistakes and not repeat them. And for the folks who have lost money, I hope to tell them that they are not alone in this journey. We will fall at some point of our journey, but as long as we pick ourselves up and don't give up, we will definitely be able to complete it. So I actually started my blog last year in October because I was making a lot of money from the stock market using options. And I wanted to share this knowledge with people as it can empower them to change their lives for the better. However, the stock market started to crash in December 21 and my portfolio suffered as well. I continued to share because I think it is comforting for people in difficult situations, example facing huge financial losses, to know that they are not the only ones facing such issues. So I realized that the more I share, the more value I can give back to this world, and that gives my life a purpose. I know that I am at least useful in some ways and can make a difference to the people around me. The more I share, the more I learn as well. Because there will be people who are kind enough to warn me about my blind spots, and I learn a great deal from them. People sometimes think by sharing they will lose out, and why should they share the good things and receive nothing in return? However, I believe that the world is big enough for all of us to exist together, and we do not have to fight and eliminate one another just to survive. By sharing, we actually gain more than we lose. By openly sharing, I'm prone to criticisms and hate comments. But I try to remind myself that haters gonna hate, and they're just a small minority of my audiences, and that many people still appreciate what I've shared. I also learn to focus on what I can control instead of what I can't. I think through these two simple questions, you can see and you can tap into the psyche of Jason. I think honestly speaking, just by running a simple blog, if you don't have enough traffic, I don't think financially or economically, it doesn't really make sense from Jason's perspective. And for those of you who are interested, I think in one of his older blog posts, he did share about his own personal life, and he definitely has a career and life outside of just blog writing. So this is probably not up his priority list, but if you're to follow him closely, based on the number of articles and the depth that he go into, he probably puts in quite a lot of effort for every single article. But anyhow, from my own personal perspective, I think by putting yourself online, out there, increasing your exposure to the world, there are a lot of intangible benefits that you will probably be able to reap. However, you do have to take into account the downside of putting yourself out there, which is getting hate comments, criticisms, etc. But I guess these are the rules of the game. So now, pivoting over to the article where we get to glean more insights from Jason's personal journey thus far. So what is worse than having a portfolio with 618,000 worth of loss? And I think this is an incredibly catchy title, so I wouldn't say that it's clickbait because it's true. So he even provided a screenshot of his portfolio via his Interactive Brokers account. So after Friday's sell down on the 10th of June 2022, because of a worse than expected CPI data release, my unrealized loss has increased from the previous negative 576k to negative 618k. So I believe at the time of this recording, which is in the first week of August, the market did rebounded quite strongly after very strong tech earnings. So I would believe that his losses would be mitigated to a certain extent. So if all these unrealized losses come from my shares, whose value has dropped significantly due to the huge correction, then I am not too concerned because I can still hold them until the market recovers. However, in my top 10 losses on my portfolio, most of them come from my options contracts that have expiry dates. That means even if I'm prepared to wait it out, these unrealized losses will automatically be realized when the contract expires, somewhere between September 2022 to January of 2024. So for those of you who are interested in the breakdown of his options portfolio, I'll leave the link to both of the blogs articles in the description box down below. You can probably enlarge it, but due to space and real estate constraint, I wouldn't be able to show you. But effectively, out of the $1 million portfolio, around 450,000 are in LEAPs. So LEAPs are basically long-dated call or put option. But if I'm not wrong, most of them are actually call options, and you can look at the details below. So this means that in Jason's current 618,000 unrealized losses, 400,000 comes from my LEAPs portfolio. And if you were to scroll through the summary table of his LEAPs, hey, he's a fellow Alibaba shareholder as well. But anyway, it's only one LEAP and it's only worth $2,600. So and in the grander scheme of things, out of a $1 million portfolio, it's not too much and it's only 0.58%. So the LEAP strategy is a double-edged sword. While it helps to magnify my returns in the bullish 2021, it has now magnified my loss in the bearish 2022 as the portfolio is down by 90%. So in his own investment journey thus far, after 9 years of investing, he has made a realized gain of 113,000, but towards the end of 2021, he realized a loss of around 135,000. He then earned around 267,000 of the profits made by the SG banks. So if his current LEAPs option contracts all expire worthless, then ultimately he will still lose around 72,000. So then he slide in a very cheeky reflection. So after 10 years of investing and options trading, I would be so much better off leaving my money in the bank, earning 0.5% interest per annum and letting inflation eat up my money. But I will not lose 72,000 away for nothing. So this is ultimately the risk reward that we always talk about. So whenever you're investing in instruments, whether is it even bonds, equities, stocks, private equity, or what other options instruments there are out there, there are always that certain level of risk that you're undertaking. That's why it's called the risk premium. So jumping back to one of the questions that I asked Jason. So I wanted to dig deeper into the thought process of why leverage. So to me, options investing is a form of leverage. Why not just buy and hold stocks? And what was the motivation behind your foray into the options world? So Jason replied, options becomes a leverage when we are using it to earn more money with a lower capital. Say for example, we buy a call option, pay a premium, and expect the stock price to rise and earn a profit of the premium increase while using a lower capital. However, there are other ways that options can complement investing, such as using put options to hedge against your portfolio, or selling put options to get shares at a discounted price, with premiums collected or to earn some income by selling covered calls in the sideways market. So he did share 4 different ways in the specific articles for options trading, and I do agree. Currently, I know there are many people who employs the wheeling strategy, where they essentially sell put on a particular company, and if it gets exercised, they will hold 100 shares of that company and then they will start selling call. And personally, I also do adopt selling puts far out into the future, because I do want to own the share at the end of the day. And if it's exercised, I'll be more than happy to pick up those shares at the share price or the strike price that I've set. That being said, based on the discussion from the article thus far, it does seem like Jason is employing some sort of leverage strategy where he's buying a lot of lead options. Albeit, all these are quite strong companies, by the way. Alphabet, Tesla, Microsoft, Nvidia, Apple, Amazon, etc. But I think the biggest problem with LEAPs still lies with the irrationality of the market. Despite holding very strong companies, your FANG stocks, your Mama stocks, etc., the market can remain irrational longer than it can stay solvent. So if you're holding stocks like me, so for example like Alibaba, so I've been in this back holding journey for more than 18 months now, and by holding the stock, I don't care whether the stock is trading at 80, 100, 120 or even $50. If I have the holding power, I'll continue holding onto my bags. But if I instead bought into LEAP options instead for Alibaba when it was plummeting down, I'm sure I'll be down more than 90% as well. So you have to take into account the irrationality of the markets and essentially a quote-unquote downside risk and how much you are able to lose. So why am I even sharing this? Writing this kind of article certainly show how bad as an investor I am, and I'm sure the haters are going to come in and say, see, I told you, this guy's an idiot. However, I'm not sharing my experience to please the haters. I just hope to tell people, friends who have lost a lot of hard-earned money, whether it is unrealized or realized loss, that you are not alone in this journey. I'm not sure if it is comforting to know that there is someone who has lost more money than you, but I sincerely hope this article sends some encouragement to you. Remember this, the reason that you are able to lose this amount of money is not because you are foolish. The reason you are able to lose this amount of money is because you have made them in the first place. So there is every chance you can make it back again. And I think it's timely enough, especially for many people who have suffered financial losses, myself included, by the way. I'm not gonna casually exclude myself. I'm definitely down big time on my Baba position as well. So it is important to keep your morale high and evaluate what went wrong with your investment. Have you taken on too much risk? Are you too complacent when times are good? And then think of what you can do moving forward. Can you salvage anything? Should you cut loss? What will be your new strategy to recoup your losses? And I think these are great guiding questions to start. If you think that you are taking unnecessary amount of risk and you probably can't sleep at night, I think the sleep test is very important. So I think we learn the most when times are bad, and this will help us become better investors or traders in the years to come. So we will gain money, lose money, then gain it back again, and then lose it again. And the cycle continues. But what we will never lose are our experiences and knowledge. The harder you fall, the more you'll learn and the better you'll become. So the last thing I wish to say is this: you can lose all your money, but what you can't lose is your health. There are many people who file for bankruptcy and then come back stronger to create their legacies, such as Walt Disney, Elton John's, Donald Trump. But if you lose your health, you lose everything. So please take good care of yourself and may the storm be over for you. So more specifically, I wanted to tap onto the 10 investing lessons that Jason has learned through his entire journey thus far. So in the first part of the article, he actually went through his journey in his forays into the Singapore stock market, his investments into local banks, and then started pivoting over to the US market and started dabbling into options trading and options investing as well. Not to provide you guys with any spoilers, if you guys are interested, please go ahead and read on. But you can look at, in terms of his profit profile for his entire portfolio, I think from year 1 to year 9, those are very modest profits, but in year 10, which I presume is 2021, it essentially skyrocketed and at least 10x from the previous year. And it is probably because he harnessed the power of options investing. But I just wanted to zoom into the 10 specific lessons that he has taken from this quote-unquote lesson from the stock market. So lesson 1, it is easy to get carried away when you are winning. So the people who lost the most money in a casino are not those who started off losing, but are the ones who have won first, tasted the sweet fruits of success and wanted more. When they lose, they raise the stakes higher to want to win back everything, thus risking an even greater loss. I had a winning start to both my investing and trading journey. I achieved a 10% return in my first year of investing and a whooping 200,000 return in the first year of options trading. Then in the second year onwards, the humbling experience came to bring me back to reality. And I think this is definitely timely advice. Ironically, when you guys are winning pretty hard in 2021, I essentially dabbled into the Chinese market and experienced the bear market for at least 2 years now. So I wouldn't say that I started off winning. Whether am I chasing to win back my losses or not, I think time will tell. But at the end of the day, we should always have a system in place because, as we know, humans are extremely emotional creatures. So don't get too swayed by your own emotions, and when the stock market tanks like 10, 15, 20%, sometimes the brain just goes into short circuit and you're not thinking clearly. So lesson number 2, nothing is responsible for your money except you. No one, especially your mentors, should be held responsible for the outcome of your investments, whether success or failures. You are the one who made the decision with or without the influence of people who are encouraging you to buy or sell. Ultimately, it is your money and your decision to do what you wish to do with it. Having this mindset is important in preventing you from going down the path of blaming others for your misery and helps you gain control of your investing game and ownership of your own happiness. I think I concur, and it's a good message for many of the commenters in my comment section down below as well. So lesson number 3, blue chip companies will not fall. It's a myth. Many people think that by buying into big reputable companies, they are likely to make money and their capital over time. So this is not true. Look at how the giants of SPH, Keppel Corp and Singtel. For international investors, all these are considered blue chip companies in Singapore. But if you were to look at the share price, it was an abomination. So they have fallen through the years because of the changes in macro environment. So even powerful FANG stocks like Meta and Netflix have dropped more than 50% in the past 6 months, and it's true. So whether Facebook and Netflix is a value trap or deep value, I think time will tell, but definitely I'm betting against it. So lesson number 4, there is always risk in investing. And I think I cannot stress this enough. When the stock market always only go higher, people think that the crypto market, the equities market is a way of kind of wealth transfer. And I guess 2022 was a sobering experience for many. So the moment that you decide to put your hard-earned money into an investment and make money work harder for you while you sleep, first understand this: you are already taking a risk that may cause you to lose some of or all your capital. The only guarantee is putting your money in the biscuit tin under your bed or putting them in the bank. Even that has a risk of your house catching fire or bank collapse if there is a bank run. Essentially, you are taking some kind of risk to get the reward that you think are worth the risk. So at the end of the day, investing is always a risk-reward game. Whether you think you are fairly compensated for the risk that you are taking with your capital that you have. So lesson number 5, cut loss is a painful thing, but it may save you from a bigger heartache. When things don't go your way or when investment decisions are wrong, the first reaction is often denial, while secretly wishing or still keeping faith that things will get better. When we get past the phase, it becomes painful acceptance things are not going to go back where they were previously. Lastly, it takes great courage to make the decision to finally cut loss because the money that you lose is no longer on paper anymore. If I have been decisive or courageous to make the decision to cut my loss earlier in my investing journey, after knowing that the oil and gas companies are not going to go back to its glory days, I would have avoided the massive 135,000 losses which I eventually lose when I sold off all the bad performing stocks in 2021. And this is a sobering advice for myself. I think as of now, I think most of my portfolio, for example, like Alibaba and Meta platforms specifically, they are down in the rate by a huge extent. And of course, it's always at the back of my mind. I'm trying to reassess the situation on whether was my assessment wrong, was my analysis wrong, did I mislook something or anything and whatsoever. But I guess I still hold fervent belief in whatever that I've studied the company thus far for at least a year and a half now. And we'll see. I think time will tell who's on the right side of the curve. So lesson number 6, don't ever ignore your portfolio or buy and forget. So there are periods of time when the share price of the stock was dropping so much that I decided to ignore them altogether. So I did average down on some companies that I thought had higher chance of recovery, but I spent most of my time away from the stock market. So I should have taken time to think of how to repair the investments, but I was too demoralized to do so. I allowed time to depress the stock price further until they were at a point of no return, where the companies ran into issues and on the brink of collapse. I think specifically for this lesson, it's a lot more nuanced. I do agree that you shouldn't ignore your portfolio, but whenever you want to start an equities position, I think your time frame should minimally be at least 5 to 10 years. And on the more controversial statement on taking the time to think of how to repair the investments, I think most of you investors out there are probably smart people. You guys probably did well, you have additional amount of money to invest. And for those of you who even have additional disposable income to save and invest, etc., I don't think you're doing too badly in life. And sometimes when you're too smart for your own good and you constantly think from a framework of, what's my opportunity cost? If I sell this and then I start chasing other instruments or other investment vehicles that will be able to promise me X amount of returns and then I can recoup my losses, etc., etc. And then you go down the rabbit hole of trying to always optimize your portfolio in getting the highest amount of return. But like I think in one of the previous lessons, always remember the risk to reward must commensurate each other. And you have to know at the end of the day what's the objective of your investments and what's the objective of your portfolio. If you always are harping on the fact of this idea of opportunity cost and trying to keep optimizing, today I'm buying Apple first and I think Apple is too slow, I start switching over to Alibaba. Alibaba started dropping, I'll cut loss, and then I started pivoting over to maybe Tesla, for example, because of the high beta and try to chase for losses. I think this is quite a controversial opinion. I think the bulk of your homework and analysis have to be done before you even start the position. But once you started the particular position where you buy into companies, I don't think the trading in and out should be that frequent, because unless something that is thesis changing, if not, you should give your investments some time to play out. So that's just my own 2 cents. So lesson number 7, keep learning and keep improving. This I definitely agree. I have nothing much to add. So lesson number 8, there will be up and down moments, but if you don't give up, you'll eventually win. I think you'll only win if you have a very sound methodology of investing, and I do hope that everyone wins in the long term. Lesson number 9, in every crisis, there are opportunities, and the greatest comes from the biggest crisis. So when the stock market crashed during the pandemic, I was able to pick up really good stocks like Singapore banks at a cheap price and later sell them for a handsome profit. I was able to use options to generate great returns when the world was still coping with the ever-mutating situation of the pandemic. Some people look back and wish that the 2020 crash had lasted a longer while for them to have more opportunities to buy stocks at a cheap price. Last but not least, lesson number 10, always remember life is more than just about building wealth. And this circles back to the idea of health greater than wealth. And I like the saying, a healthy person has 101 things in his mind, but a sick person only has one thing in his mind, which is to get better. So now, pivoting over to the questions that I've asked Jason, and so given his experience thus far, what is his opinions of options in today's climate? So still being a newbie trader, I think it's challenging to use options in today's climate because the market is very volatile. Options is about predicting future price movements so that you can gain some premiums out of it. So if stock price can rise and crash in a single day, it means you can be right or wrong on the same trading day. It is also difficult to sell call options if the share price has fallen by quite a bit in a bear market. So selling near your break-even price means almost no premiums, but selling a low strike price means you risk losing your shares at a huge loss if the contracts get exercised. So personally, like I said, I only sell put options in this climate. I also didn't bother selling call options on my Alibaba position because at the end of the day, we really don't know or we can't really grasp what China is doing. And for those of you who knew what happened to Liu He when he announced that essentially the stock went up by 20-30% in a single day. And those kind of volatility and those kind of movement is extremely common in today's stock market, which made me rethink again if I want to start dabbling into such option strategies. So next, what is his game plan moving forward? So his game plan is to be prepared for the market moving in either directions, up or down, or not moving at all. When the market is bearish or stays sideways, I continue to sell cover calls to get some premiums as my sideline income. When the market turns bullish and rally back to all-time highs, I will sell off my leap contracts to redeem my capital that is trapped currently. So what is his biggest mistake and biggest lesson, if he can only choose one? So I think on hindsight, not having a cut loss / risk management strategy is the most lethal mistake of my short trading journey. I was still in denial mode when the stock market started falling in December and continued to fall in January onwards. I had thoughts that my long-term option contracts would give me enough buffer to tide through any dips, but the fall in the bear market for the last 6 months was hard and something that I have not experienced before. I entered the US stock market in 2021 when it was on a great bull run. So the lesson learned would be to endure the short-term pain so that you can avoid the long-term pain. Have a cut loss plan and be prepared to leave when shit hits the fan, especially in options as there is an expiry date. I think ultimately, this is just a different investment philosophy at the end of the day compared to myself. I'm probably the boring buy and hold stocks and I'm not going to do many fanciful strategies. I'm probably not considered like quote-unquote trading, but I'm not denying the fact that, hey, there are very successful traders in their field and there are many people who manage to profit upwards, downwards, or when the market is even trading sideways. So that's the beauty of the option, but I guess at the end of the day, it's always about risk management when you are engaging in this sort of strategy, and you should know how much you are able to lose. So some parting words. People go into investing for one common reason, that is to earn more money as compared to leaving the cash sitting in a bank and losing value over time because of inflation. However, investing has its risks and we do not want to run into a situation where we lose much more than what inflation can take away from us. Thus, it is always good to equip ourselves with the knowledge that can not only help us make money, but also help us not to lose a lot of money to the stock market. So this journey is full of ups and downs. Don't despair if you have made huge losses because many great investors made mistakes and lost money as well. But the reason they became so successful is because they never gave up after making the mistake, and at the end of the day, what is important is that you earn more than you lose. To sustain the long run, it is not always about being smarter or more knowledgeable. Sometimes it is about being more resilient and not cracking when the pressure gets high. In order for us to do that, we first need to take a good look of ourselves, our health, without which we wouldn't even have a quality of life. Losing money may seem demoralizing, but losing health is a greater tragedy. So I just hope that everyone can get the most out of their investing journey so that they can build wealth and improve their quality of time and have more time for their loved ones. When we build a happier community, the world will become a better place. So I'm definitely not here to put down other investment philosophies and strategies. So if you're a trader, you are playing by a different set of rules. So if you're a buy and hold kind of guy, then you play by the buy and hold kind of rules. So if you want to use investments to supplement your investment strategy, it's good as well. As long as you know what you're doing and you have enough knowledge and you know how to cope the downside risk, then kudos to you. I think there are no hard and fast rules in investing, and at the end of the day, there is no correct investment methodology. There is only one that suits your personality and your temperament. So with that, I'll see you in the next video, but more importantly, I will see you on the moon. Goodbye!